Section 12, Deregulation of Subprime Lending. Don't default. The following week, Melissa met with a first-time homebuyer who had been reading articles about the 2008 financial crisis. Before they even discussed homes, the buyer asked a question Melissa had never been asked before. What caused banks to make so many bad loans? Melissa paused for a moment before answering. That's actually a great question. Rather than giving a quick explanation, she invited the buyer to return after lunch when David was available. As everyone gathered around the conference table, David smiled. Understanding what happened before the housing crash helps us appreciate why today's lending standards are much stronger. He explained that throughout the 1990s and early 2000s, there was tremendous pressure within the financial industry to expand homeownership and increase lending. Financial institutions wanted to make more loans, investors wanted more mortgage-backed investments, and many believed housing prices would continue increasing indefinitely. As profits increased, lending standards gradually became less restrictive, allowing more borrowers to qualify for mortgages that may not have been appropriate for their financial circumstances. Melissa asked, "Is that what people mean when they talk about deregulation?" In many ways, yes, David replied. He explained that deregulation refers to reducing government restrictions and oversight over financial institutions. One of the most significant changes occurred in 1999 when Congress passed the Gramm-Leach-Bliley Act, GLBA, which repealed key portions of the Glass-Steagall Act of 1933. Glass-Steagall had originally separated commercial banking from investment banking after the Great Depression to reduce financial risk. After the repeal, banks were allowed to combine traditional banking, investment banking, and insurance services under the same corporate structure. Supporters believed this would increase competition and financial innovation, while critics argued it encouraged institutions to take greater risks. David continued, at the same time, lending standards were becoming much looser. He explained that many lenders began approving mortgages with little documentation of a borrower's income or assets. Some loans became known as stated income or no documentation loans because borrowers were not always required to fully verify their financial information. Combined with adjustable rate mortgages offering low introductory payments, these lending practices significantly increased risk throughout the housing market. The buyer looked surprised. So people could qualify without proving they could really afford the loan? In some cases, yes, David answered. And when those introductory interest rates expired, many borrowers suddenly faced much higher monthly payments they couldn't afford. Melissa remembered learning about mortgage-backed securities during the previous lesson. So the loans didn't just stay with the bank? David explained that many of these mortgages were bundled into mortgage-backed securities, MBSs, and collateralized debt obligations, CDOs, and sold to investors throughout the world. Because many lenders sold the loans instead of holding them, there was less incentive for some institutions to focus on long-term repayment. As housing prices continued rising, many investors believed these investments were safe. When borrowers began defaulting in large numbers, however, those investments rapidly lost value, contributing to widespread financial instability. Melissa asked another question. Weren't government agencies monitoring all of this? They were, David replied, but many experts believe regulatory oversight failed to keep pace with the rapidly changing financial markets. He explained that several agencies were responsible for supervising different parts of the financial industry, but complex financial products and rapidly expanding mortgage markets outpaced existing oversight. The combination of aggressive lending, securitization, speculation, and inadequate risk controls contributed to one of the largest housing and financial collapses in American history. The buyer leaned forward. So what changed after the crash? David explained that Congress responded by passing the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. Among its many reforms, the law strengthened consumer protections, increased regulatory oversight, and introduced rules designed to help ensure lenders evaluate a borrower's ability to repay a mortgage before extending credit. The legislation also included the Volcker Rule, which restricted many banks from engaging in certain speculative investment activities using depositor funds. While portions of financial regulations have been modified over time, many consumer protection requirements established after the financial crisis remain in place today. Melissa smiled as she wrapped up the meeting. I think one of the biggest lessons for realtors isn't about memorizing banking laws. David nodded. It's understanding why those laws exist. He explained that today's real estate professionals benefit from stronger lending standards designed to protect consumers and create a healthier housing market. Realtors should never encourage buyers to borrow beyond their financial means or recommend specific loan products. Instead, They should work with qualified lenders, educate consumers about the transaction process, and encourage buyers to fully understand their financing before making one of the largest financial decisions of their lives. As Melissa watched the buyers leave the office, she realized that history had permanently changed the real estate industry. The lessons learned from deregulation and the housing crisis continue to influence mortgage lending, consumer protections, and realtor responsibilities today. Understanding those lessons helps real estate professionals better protect the public while maintaining confidence in Arizona's housing market. In the next section, we'll examine the consumer protections and lending safeguards that continue to shape today's mortgage industry, and how realtors can recognize potential warning signs while staying within the scope of their real estate license. Online discussion. Discussion question 1. Why did the repeal of portions of the Glass-Steagall Act become a significant topic after the 2008 financial crisis? Answer. Many critics believed it allowed financial institutions to engage in riskier activities by combining commercial banking and investment banking, while supporters argued it improved competition and financial innovation. Discussion question 2. How did reduced lending standards contribute to the housing crisis? Answer. Some borrowers received loans without adequate verification of their ability to repay, increasing the number of defaults when loan payments became unaffordable. Discussion question 3. What lessons should realtors take from the financial crisis? Answer. Realtors should encourage informed borrowing, work with qualified lending professionals, avoid giving financial advice, and focus on protecting the public through education and ethical practices.